Good morning again, folks. This is a continuation trade of the same price leg. So we had, as expected, we had expansion, consolidation, all right, protraction, the entry, and then expansion again. With these pending sell side targets. So target one was this rejection block. Excuse me. And target two was this sell side liquidity pool. So once again, we go through the remove all drawings. We go through the process, which is the weekly. We have rejected off this weekly order block. All right. So we expect one of two things. We expect a second touch and then expansion downwards, or we expect directly an expansion to the downside, which is what I am favoring at the moment. So at the daily, we are disrespecting this bullish order block. So the daily candles are respecting bearish PD arrays, like this breaker, and disrespecting bullish PD arrays, like this one over here. This order block lookalike. Now, as soon as they printed this one, as soon as they printed this candle to us, then I suspected that it would be a fake order block, so a fake engulfing candle. So me personally, I think the leg down has started already to the original consolidation. So anyway, we go to the weekly profiles. Okay, so we got the weekly bearish, we got the daily bearish, and now we open the weekly profile, the 2-hour chart. We got the previous week looking like this. Now we go deeper into the daily chart. So the week opened with a gap to the upside on my broker. I'm not sure what happened on yours. And as soon as here's one for the notes. As soon as any candle opens, especially the weekly and daily, and they rally towards one side or they decline to the other side, then more often than not, that's the Judas. That's a fake move. So it's reasonable to be fading that, as well as the weekly and daily being bearish. That also aids in the in the fading of any Judas or any rally from the opening price. All right. So the week opens. You go to the 5-minute. After going through the weekly and daily and the 1 hour, which is also, let's take a look at that, which is also respecting bearish PD arrays and breaking through bullish PD arrays. Right? So the 5-minute chart, we see a rally into a higher time frame PD array, which is this excuse me, which is this rejection block right here. So we have a rejection block. All right. We have a 5-minute order block slash breaker combo, which we'll mark like this. We take those two up close candles plus the order block, blend them together, and you got yourself a PD array on the lower time frame to match the rejection block. So this is the part where the reaction is important. So when I saw this rally occurring, you never want to fade the first move. Again, the first touch of a key level. I usually, unless we're indicating super bearishness, which is just not even retracing, just dumping continuously, then maybe I will accept one touch of a key level. But usually you don't want to fade the first touch of any key level, because more often than not, it's going to either come back. They're either going to come back to turtle soup it or to failure swing the same key level. And in this case, you got it. You got the first touch. You got a decline, making everyone think the top's in. All right. So someone went short up here with reason, and now he's in profit. The market is fooling you into thinking that the top is in. So you put your stop right here. And that's when you get taken out. All these buy stops over here are accumulated. Someone is accumulating shorts above this high. All right, into a higher time frame PD array. The classic 2 touches of a key level. So the people who were short here got stopped out. And this also will induce new buyers. So it's always building liquidity. The market is always building liquidity to transfer the liquidity from one high to a low or a low to a high. All right. And this is the mechanism, which is someone went short up here. He thinks the top is in, so he keeps the stop loss. He trailed his stop loss to this high. Rallies is taken out, and these are people with the deep pockets. It's not just it's most of the market participants, which is not me and you. It's other entities, which are not smart money. Two different things. Is it smart money, and the people being taken out by smart money. So in a way, it's a battle of giants, which me and you and the listeners and the quote unquote retail traders are simply participating in. We're just going within the tides. We're going with the waves, right? We don't move anything. The markets are moving, and we simply choose to join or not join, because they're going to move regardless. So went short here, put their stop loss up here. They think the top is in. First touch of key level. It rallies back up to take them out and accumulate shorts, and then distribute them to the downside at the targets, which is 1, this low, 2, this low, and 3, these lows. These 2 as a scalp, and this 2 as a short-term trade. All right? And that is turtle soup right there. So I went long right here. Thanks to the slippage, it filled me in a bit below, but that's fine. And the stop loss for this one was mine was a bit conservative as usual, because I like to play it safe. But a valid stop loss would be right above this order block breaker combination. So this was an intermediate term high, which is a pretty safe stop loss. If order flow is really bearish, if it's truly if your analysis is correct, then that will not be touched. And as you can see, it wasn't touched. Mine was a bit higher, of course, because I like to play it safe, as I have said many times, and I will say many times to come. So that's what a trade idea would look like. That's what I had in mind when I was selling over here. Enter, target, and stop loss. That's a quick 1, 2, 3 to start of the week. To start off the week, not at the week. And if you missed, let's remove this garbage. Remove. That's the higher time frame PD array, right? This bold line. Remove. So if you missed this turtle soup, which is my entry, which is my preferred entry of choice, then you can enter at this breaker right here. As soon as we close through the candle, you got this breaker as a continuation play. All right. Of course, you have some other ones up here, like this order block, but those are on too small of a time frame for me to consider them as clear entries. This one is the first continuation entry, which was clear and obvious and undeniable. And then the second one was this breaker. As soon as we close below the breaker, then it is activated. And the third continuation entry was this fair value gap. I was watching these, but I didn't feel enticed to take any of them. So that was the idea. 1 hour PD array. All right. Rejection block, lower time frame. After seeing the higher time frame PD array, you go, you look at that first touch of the key of the high time frame PD array. Decline. This could be the top, by the way, but we are not. We don't speak in absolutes. We speak in probabilities. Okay, so more likely than not, a key level will be hit more than once in an M shape. Let's draw this one out. So here's a key level, for example. It's either going to be hit in an M shape, whether it's turtle soup or whether it's a failure swing. All right. That's for the bearish key level, or it's going to be hit in the W shape, turtle soup or failure swing. So always anticipate a second touch of a key level. That's the reason why most. That's the reason for most break-even stop outs, is because you are not anticipating the second touch of the key level. So yeah, that's it. I don't want to. I did not want this to go 15 minutes, but it did. So that's all I have for today, for you guys, and good luck and good trading for the rest of the week.